son, enjoy the ride. Least time, enjoy the ride. Yeah!
And now more Operation Freedom with your host, Dr. Dave Janda, on Southeast Michigan's conservative powerhouse, WAAM Talk 1600. Call Dave now at 822-1600. That's 734-822-1600.
Welcome back to Operation Freedom, folks. I'm Dr. Dave Janda, broadcasting from our Freedom Bunker here at WAAM Talk 1600. Again, this show will be up in podcast form for you at davejanda.com by 9 p.m. this evening. Not a spectator sport, folks. The more people we have in the know, the more people we have protected, and the sooner we end this reign of terror, if you will, by the globalist syndicate. The show will be up in podcast form for you at davejanda.com by 9 p.m. Download the show, network it to anyone and everyone you know. As you know, folks, one of the focuses of my show since we first started airing in October 2010 is to try to enhance your economic and your financial freedom. We have had a number of guests come to you and help protect you from a syndicate that I believe is absolutely enthralled with trying to strip you of that same economic and financial freedom. I'm honored to have back with us today a new guest, actually, someone who's going to, I think, enlighten you as far as what's really going on behind the curtain when it comes to your financial welfare. She goes by a name to plume of TraderStef. Beginning in 1996, TraderStef initiated a career spanning 14 years within the New York City investment banking industry. She acquired a diverse skill set in human resources, technology and communications, training, education and development, business analysis, and global risk. She began investing in precious metals actually back in 1999 while following market trends post the dot-com bubble in 9/11. Steph then left the banking industry in 2009 after 5 years in the global risk management at Citigroup. Steph then developed and hosted a live precious hour, if you will, a webinar specializing in gold, silver, and the mining equities, combined with research of industry fundamentals, financial markets, global news events, geopolitics, monetary policy, otherwise known as fusion analysis. Her work is currently featured on the website crushthestreet.com. Crushthestreet.com. TraderStef, welcome to Operation Freedom.
All right, Dr. Janda, thanks for having me.
So, Steph, let's start with your front row seat that you had to the financial crisis in 2007 and 2008, because you had a front row seat, as I mentioned, and many of us were not even in the stadium.
Absolutely. Love to. First, I want to say that most folks have been said the storyline that it was the subprime mortgage industry that precipitated the crisis. Mm-hmm. That's not really true. It was actually the derivatives that were created, particularly post 9/11. It wasn't because of consumers getting mortgages who were drawing in with free money and taking out things like, what are they called, ninja loans? Mm-hmm. No income, no job, no assets, as well as adjustable rate mortgages that could have also included a balloon payment and then much higher rates down the road. There's a great movie out there. If you had not seen it yet, I would recommend The Big Short.
It's awesome.
It goes into details about that whole game. So let's fast forward to September, actually backtrack, September 2008. And I'm working in the industry, and my particular area was not involved in mortgages per se. We were more concerned about the overall picture of global risk and what kind of risk were we having on a cross-border basis, mm-hmm. particularly, mm-hmm. to exposure to crisis and how we would handle that in the future. So there was a suggestion that week when things were really hitting the fan, and there was a meeting that was being arranged at the Federal Reserve Bank in New York. And one of those ideas that went across the desk was to create a good bank and a bad bank. That's basically accounting magic. Let's move the bad stuff over here, keep the good stuff over here, and everybody will think it's okay. Well, that's also known as mark to fantasy rather than mark to market.
Right.
That's what they used to call it. But Lehman Brothers was in the headlines that particular weekend. Mm-hmm. And they actually put that out there for a psychological test, let's say. And they called it Spinco. Now, you can't make this stuff up. That didn't go too well. And their stock prices kept falling. The value of their derivatives and their balance sheet continued to deteriorate all day. It was a real mess. Now, on the afternoon, that meeting at the Fed was being arranged, and Dick Folt, who was the CEO of Lehman Brothers, begins to realize how bad things really are. So let's set the scene here. There's a film that was put out called The Last Days of Lehman Brothers. It's a BBC documentary. And I would have to say that is pretty much as close to reality as you're going to get. Now, some of the dialogue was created for the movie, but it's pretty much on spot from what I witnessed and what I heard from my seat in the stadium. So Timmy and Hank, otherwise known as Timothy Geithner, who was in charge of the New York Federal Reserve, and Hank Paulson, who was at the time the Treasury Secretary for the U.S. government. Now, Dick Folt at Lehman Brothers was not invited to that meeting. He was not happy about that. But his legal team was there sitting outside in a separate area, and they were going to be kept up to date with what the results were going to be because Lehman Brothers needed to be bailed out. Things were really bad. So Tim and Hank come into the room, and you got all the too-big-to-fail bank CEOs sitting in this room. And Tim begins to set the scene for these bankers of why they're there, and they're getting a little upset. There's some unrest going on about how they feel about this. So Hank jumps in, and he says, look, there's no public money for a bailout of Lehman. Now, it's important to remember that Fannie Mae and Freddie Mac an arrangement had been made to bail them out just 1 week prior to that. So the concept of there not being public taxpayer dollars to bail out Lehman, they thought that was a joke. So they weren't taking Hank Paulson very seriously, much less Timothy Geithner. So at the end of all of it, the U.S. Treasury actually ended up purchasing $100 billion of their preferred stock in mortgage-backed securities from Freddie and Fannie, and they were put into conservatorship by the Federal Housing Finance Agency. And that kept them afloat, and it cost taxpayers $187 billion over time, making it the largest bailout in U.S. history. Now, the Fannie and Freddie bailout was greater than the 1989 savings loan crisis, which cost the taxpayers $124 billion. And that was on par with AIG. Now, remember, AIG was an insurance company that was caught up in the financial crisis, and they insured mortgage-backed securities and derivatives, and that bailout started at $85 billion, which grew to $150 billion. Now, that's small potatoes compared to the original $700 billion bailout that was planned, which actually turns out to be somewhere around $25 trillion because the Federal Reserve bailed out the global financial system with dollar swaps and other types of financial instruments. So these CEOs are skeptical that they're being told there's no bailout, and they have to make a deal. So here's where we step into the area of what they call moral hazard. It's a huge one, right? So if there's no deal, Lehman's going to get hung out to dry. Now, John Mack, the CEO of Morgan Stanley, he left the room. And he was convinced, Hank Paulson jumps back up and he lets them know that, look, there's no bailout money and the West is screwed. Now, I need to step back again and put this into perspective because back during long-term LTCM, let's call it that way, there was a bailout in the late 90s. And the Bear Stearns CEO, Jimmy Kane, did not help with LTCM, the bailout. Now, remember, Bear Stearns went down in a financial crisis, too. And Dick Folt of Lehman Brothers, he had always been described as a belligerent and unrepentant, I'll put that in quotes, as one of the worst American CEOs of all time. And it's well documented in one of his company videos, which he said, quote, rip out their heart and eat before they die, unquote.
Oh, special.
So he wasn't liked. So look, you see what happened to Bear Stearns and Lehman. You have to make the connection that people really didn't like them, and that's one of the reasons they get screwed. So back to Paulson. We're at the table. We've got Dick Folt sitting away from this meeting. He's not allowed. We have John Mack leading the meeting. Hank Paulson says, the West is screwed. We screwed it all up. All of us. The West. It's done. It's over. You think it's a game? Well, here's the game. You want your great-grandchildren speaking Chinese? The dollar's going to go. It's done. We had Rome. We had Europe. Then this thing, cars, hula hoops, stereos. We screwed it all up. We ran through all this stuff, and we've come out on the other side. I don't know where this is. What is this place? And we have this one weekend where maybe we can come up with something to hold it together a little while longer.
Boom. So, then what happens, Steph?
They printed a lot of money.
A lot. Trillions.
And
Trillions.
They put it together. With that said, let's fast forward to today. We are 100% of debt to GDP ratio in the United States, which means we're insolvent. We're broke. And we have unfunded liabilities, which include things such as Social Security, Medicare, Medicaid, which is over $200 trillion alone. And the derivatives bucket, despite the regulations that were supposedly passed with Dodd-Frank, the derivatives bubble is bigger than it was in 2008.
But Steph, when I listen to Fox Business News and Stuart Varney and CNBC, what I call CNBS, and read Reuters and Bloomberg, they tell me and all of us that it's all fine. And gosh, the stock market's hitting all-time new highs and everything's great and everything is fixed from 2008. And Steph, it sounds from the picture you've painted that we had a disaster in 2008. We still have the disaster today. It was never fixed. It was papered over. And in fact, it's worse today than it was in 2008.
That's my take on it.
Okay. So then our listeners are then asking, well, wait a minute. Why is my 401k going up every day? Why is the stock market hitting new highs every day if things are so bad?
It's a form of financial repression. And remember, there's only two asset classes that are visually, daily, Monday through Friday on business days, that the general public, or average Joe, if you want to call it, are exposed to. And that is the stock market's making all-time new highs. And house prices are higher than they were before the crisis.
Right.
So that has a psychological effect. But the underlying fundamentals of that is that the stock market is high as it was because of all the money they printed, number one. And number two, the corporations were basically buying back their stocks with all the money that they were given. Now, housing prices are going up for various reasons, but all housing is local, right? But and wages are actually falling. They're not rising because of inflation. And when they say there's no inflation, you know who they're kidding, right?
Right.
Of course there's inflation. You've been to the store lately?
So, Steph, play this out. If we are in more of a precarious situation today than we were in 2008, and we know what happened in 2008, right? How does this play out? Because they can't keep printing money and keep this Ponzi scheme alive forever. Because some people are going to say, well, they've been doing this since 2008, and we're 9-10 years into it, so they can do it for another 10, 20 more years. Can they?
No, at some point something has to give because we don't have a positive cash flow. And if you've ever ran a business, that's called bankruptcy.
Yes, it is.
So they're going to continue to print it over as long as possible until we hit the next financial crisis. What's that going to be?
What is it going to be?
I don't think anyone really knows. But let me throw a few ideas out there for the listeners to consider.
Fire ahead.
The next big crisis it's hard to determine what the actual trigger point is going to be, which can also be called a black swan. Because the size, the scale of the system is interconnected. It's so huge. That's really the problem, is the interconnectedness. And standard financial models really don't reflect the reality and the complexity of the system. Now, there's a thing called complexity theory, which Jim Rickards discusses quite often, and he's very good at it. And it's not a theory that is used in it's used in academia, and some economists talk about it, but it's not used, let's say, down at the Fed, because all the Fed models aren't really working.
Mm-hmm.
You know, they're looking at the Phillips curve, which is not working. They can't understand why they're not getting their inflation rate above 2%. So we got this huge complex system, debt, derivatives, there's a fragility in the system. And Jim Rickards also coined the trigger point as being an ICE 9 event. So ICE 9, I don't recall exactly where he pulled that term from, but what it means is, you know, someone developed some molecule and they dropped it in the ocean. And that molecule is designed to take over all the other molecules and the atoms within the ocean and turn it into something else. Mm-hmm. And then you get the domino effect. Mm-hmm. Well, that's what it's going to be. There's going to be a certain type of event that's going to be triggered that's going to create an ICE 9 event. So
in the financial world.
I'm sorry.
In the financial world, an ICE 9 event.
That's right.
Mm-hmm.
So we got household and corporate debt that's through the roof, mm-hmm. and we've got global central bank balance sheets that are out of control. Mm-hmm. We got $1.5 quadrillion worth of derivatives worldwide. The Federal Reserve is leveraged basically 115 to 1. Mm-hmm. That's insolvency.
It is.
They're printing money. They're going to print money until confidence is lost. That's similar to what happened back in the 70s. Mm-hmm. You know, when you couldn't get gold for your U.S. dollars anymore. Thank you, President Nixon.
Right.
There was a loss of confidence in the system, and then there came inflation. So, look, the Fed thinks that they're going to reduce the balance sheet because they ran it up to $4.5 trillion. They want to reduce it down to somewhere around $3 trillion and raise interest rates at the same time.
Good luck.
Not going to happen. Look, the U.S. gross national debt jumped $723 billion within the past 12 weeks. Now, if that's quantitative tightening, as they're calling it, QT,
right.
I have no idea what they're doing because it's not working. So they're trying to avoid getting in a corner in the next recession. They want to have interest rates up to a certain point so that they can take some type of action. But in my personal opinion is, we're actually in a depression mm-hmm. since 2008, and we may have a recession in a depression.
Mm-hmm. So what do folks do to protect themselves, Steph?
Well, the latest thing going on out there is cryptocurrencies, as everyone has heard. Mm-hmm. But the issue I have with cryptocurrencies is counterparty risk. Mm-hmm. So when you want to retain your capital, you want to make sure that there is nothing between you and that asset that can take it away from you or have a liability upon it. So whatever that asset is, you want it to be in your hands. Just like if you own a house, you pay for it, you live in the house, you own it, you have it. Whether it be land, you own a railroad, you own a piece of artwork, or some other type of commodity, you want to have it in your hands. With something electronic, you run into some issues. It's hackable. It's being tied into the globalist system of digital ledgers and digitizing everything where it'll be centralized. So I can only revert back to, look, I have nothing against someone being a speculator in the cryptocurrencies market. And if you're going to go in and trade and pull profits and then reinvest that into something else with fiat currencies, by the way, invest in something that's a good asset that doesn't have that counterparty risk, I think that's a good plan. And that would be something that's been around for 5,000 to 6,000 years, and it's something that they still stuff in the basements at the central banks. And we all know what that is, gold and or silver, but primarily gold because it retains your purchasing power.
So, Steph, many people have said, well, I've listened to the guests Janda has on, and I've purchased gold and silver since they say the inception of the show, some of his first guests spoke about this, about the financial system being tenuous. But it appears that these markets, the gold and silver markets in particular, have been manipulated with paper assets to diminish the price of the physical asset of gold and silver. And many folks, Steph, are like, I'd rather buy a couple shares of Facebook or Apple. They've done much better. Or try to scratch enough money together and buy a half a Bitcoin. What do you tell them, Steph?
I'll tell them, I'll explain counterparty risk to them.
Mm-hmm.
And I'll also say that when you look at a gold, let's say a gold chart specifically versus a U.S. dollar chart,
yes,
U.S. dollar is falling. It's lost 95% of its purchasing power.
Mm-hmm.
A gold chart, you look at the monthly, it's a beautiful chart. And actually, since January this year,
mm-hmm.
we're up. What percentage are we up here? 17%. Dollars down 13%. There's nothing wrong with gold. It's doing wonderful. It's just that everyone doesn't want to miss out on the next thing or get into the next bubble. The question is, are you going to have that asset in your hand when all is said and done? Is it going to retain its value?
Steph, you spent time on Wall Street, as I mentioned in your introduction. Do bankers, central bankers, do you believe they personally own gold and silver?
Yes, I do.
And do you believe that when gold and silver gets manipulated down in price, do you believe that they buy more gold and silver or for their personal accounts, or do they sell their gold and silver because the price is falling?
They do what sovereign nations such as Russia and China are doing. They buy the dips when it's on sale. Now remember, gold is leaving the West and going to the East. And there's a reason for that, because they don't want to be involved in the U.S. In the U.S. dollar, Petrodollar system, they're trying to create their own system, and they're going to eventually back that currency, whether it be WAAM or rubles, in a percentage of gold. Now, if they just took 40% of how much fiat money has been printed out there from the four major countries, you have $10,000 an ounce gold. Whether it's manipulated by paper or not is actually irrelevant, because at the end of the day, the paper is going to fail. What's going to be left standing? It's going to be what you have.
Steph, I'd like to thank you for everything that you've done, are doing, and will do. You are a tremendous resource. You have tremendous courage to come forward and speak about what you've experienced in the front row to all of us who aren't even allowed in the stadium. Folks, you can follow TraderStef at crushthestreet.com. Folks, you're listening to Operation Freedom. I'm Dr. Dave Janda, broadcasting from our Freedom Bunker here at WAAM Talk 1600.